started out my career in forensic accounting, basically doing whether it's bankruptcies, fraud, Ponzi schemes, all sorts of interesting stuff like that. I kind of specialized in different elements, but one of them was the compliance side of that work. And being Florida was a very international city, a lot of South American clients and cases, so as a result I became very familiar with the expat tax laws. And ultimately my career kind of segued into just regular expatriate tax returns for Americans. Ultimately I became the senior manager of tax at BDO, basically the Middle East. I was there for a few years, and then that last year kind of went on my own, started my own practice. I specialized in doing expatriate tax returns for Americans, and also doing forensic work, whether it's investigations, bankruptcies, fraud, all sorts of different those different areas. So tonight, though, we're obviously going to discuss the U.S. tax returns, U.S. tax compliance, laws as it relates to expatriates such as yourselves. Start with December 31st is coming. That is the end of the tax year for the vast majority of Americans, and this is the time for planning. You got another month you can make. There are certain things that can be done to reduce or mitigate any tax obligations that you might have for this tax year. And at the end of the discussion, we kind of will get into some of that. So for now, though, because I'm not sure, who here filed a tax return this past year? Okay, and the FBAR? And who did it themselves?
Who did it themselves?
So, I just like to have a basis of where, the level of knowledge of where, people are coming from.
Excuse me, does your sound system not work?
This sound system, unfortunately, is not working. Can we ask them if they can turn it on?
Okay.
If it's possible.
That would help.
Yes,
Yeah,
it
would
would.
that help? I'll try to talk louder, though.
Thank you.
Project a little bit louder.
Or you can come closer.
Or keep it
I'll
down.
sit in
That's a
there.
better solution. Okay. So first is every American and green card holder must file the tax return every single year. It does not matter whether they live in or outside the United States. Green card holders, by the way, also include people that at one point had a green card and decided to leave the country and didn't surrender their green card to the appropriate U.S. authorities. So if you had a green card, think you're off the hook. You're not until you actually surrender the green card formally. Usually you have to go to the consulate or the embassy to do so. So just something to keep in mind, if you know somebody like that, where they say, oh, I used to have a green card, but I left the country ages ago, and technically according to the green card rules, if a resident alien who has a green card just leaves the country to move outside the country, technically that green card is supposed to kind of be null and void as soon as they actually leave the country, as soon as they leave the United States and live somewhere else. Practically, people don't, they do it. They have the card. They don't tell the U.S. authorities that they've moved somewhere else, and so the card still has some sort of value. But even if they were to go back to the United States and it wouldn't be respected, and the card would be kind of ditched at that point, until they surrender it or give it up, for IRS tax purposes, they're treated as if they're a U.S. citizen for just about all purposes. The tax returns must be filed based on certain income thresholds. So that there are people, if your income's low enough, where you actually have no obligation to file a tax return. Most people aren't in that boat. There are some, but most people don't fall below the threshold. If you owe anything, even if you have less income than the threshold, let's say somebody earns $1,000 a year, but all of it is in the form of self-employment income, and they are subject to self-employment tax, then they would be in a boat of having to file a tax return because they would owe a little bit of tax on that $1,000.
She's here too.
Yes. All Americans and green card holders. Oh, better?
No, it's good.
It's
No,
good.
good.
It
Yeah, you're
works.
better.
It's the other one that works. Yeah.
One and two. All Americans and green card holders must file, must report any corporations, partnerships, trusts that they own. Obviously, in the United States, that's a given that they'd be filing those. But even if they're outside the United States, if you are owner, depending on certain circumstances, but generally, if you own more than 50% of a corporation that's registered outside the United States, and trusts and all sorts of, if you have a beneficiary or grantor, all of these you would need to file, you would need to report this to the IRS, and not doing so could expose you to very significant penalties. For trust, for corporations, it could be a $10,000 penalty. Even if you have no tax related, you wouldn't owe any tax, but by being late, you can get the penalty. I have actually seen it in the last few years, not necessarily on the personal level, on the corporate level. I have seen corporations that these rules apply to them as well. If an American corporation owns an offshore corporation located in Seychelles or in Geneva, or it doesn't matter, and they fail to report on time the 5472, which is a special form that reports 5471, that's a corporation based outside the U.S., not reporting this, it's a pure information return. There's no tax connected to it necessarily. If it's purely informational, by being late, they got hit with a $10,000 penalty, and there was nothing they could do, and the IRS did not have very much pity on them, and it was kind of, they shrugged their shoulders and said, well, pay up, it's the rule, and they can enforce these on, I personally have none of my clients have gotten hit with the 10,000 on the corporation yet, but it's yet. If they want, they can enforce these penalties. It's on the books, the laws are there. They've been nice enough not to enforce them so far. So it's something to be aware of though. Tax is calculated only based on income that you earn. It is not based on wealth. I know in many countries in Europe, around the world, there is wealth tax or some form of the wealth tax that can be imposed. The U.S. does not do that unless, with the slight exception of an inheritance of an estate. But that's a number of factors need to come together before that would even result in any tax. But as long as you're alive, there's no such thing as a wealth tax. So you're clean on that one. Not filing the tax returns correctly or leaving important parts of it out can subject you to penalties, to potentially even criminal prosecution, depending on how bad it is. These are reasons that you want to actually file your tax returns. The statute of limitations on filing your tax returns often is 3 years if the mistake's not bad, but if there's fraud going on, it can actually be much longer. And there are situations where it could even be a never-ending statute of limitations. Not filing a tax return is also an endless, there is no statute of limitations. The IRS theoretically could come after you 50 years later and say, where was your 1965 tax return? We think you owe us money. Theoretically, it could happen. Again, haven't heard of anything that bad, but it would almost be a cause for, not celebration, but it was like, wow, they actually did it. They went after somebody for a tax return 40 years old. Now some random side notes, just because I've been doing this lately. I had a case where it was a forensic case where I had some clients with some fraud going on. They're getting bribes. That is subject to tax. If you know anybody who's receiving bribes or kickbacks, and they're American,
Taxes.
they actually should be paying taxes. It got Al Capone, and it can get them. There is tax on all income, whether illegally or legally obtained. Drug sales, all sorts of different things. Yeah, you got to declare it, and the DEA might not care very much, but the IRS definitely cares a lot, and they actually have sometimes even better mechanisms for enforcing their rules. And I'll get into that a little bit later on. The last question is, or last one of the thoughts was alimony. Recently came up. Very recently had a case that I'm dealing with a client, And alimony is subject to tax. Alimony received, even if it's from a non-American. Alimony received is subject to tax. There are ways to get out of that, but it involves some legal maneuvers and structuring some of the alimony payments. And there are ways to avoid it, which is something that can be applied to a lot of the tax code. If you structure your financial situation well, you can significantly reduce your taxes that would be owed to the United States. And we'll get into it later that obviously once you're overseas, there are all sorts of pitfalls and also potential advantages that you can take advantage of in terms of working with the U.S. tax code to either obviously to reduce at least your U.S. tax obligations. So on to a key thing to be aware of with the IRS. They don't want to make you, if you ever get audited or people that do get audited, their goal in life is not to make you miserable. It is to collect money. That is all they care for. And you always have to keep that in mind. If somebody is audited, when I've had clients get audited, I've gotten them more after they got the audit papers in the first place, and then thankfully, none of my clients yet have actually gotten audited on a return that I did. Which I've done a lot too. I'm like, wow, statistically it should have happened by now. I've done thousands of them, so at least somebody should have gotten audited somewhere. But
That's a good advertising.
I know. I'm the audit doctor.
You can be the one.
Oh, wait a minute, I haven't signed up. Maybe I don't want to now.
But like the joke about what you shoot the arrows at the tree and then paint the target later
Yes.
on. But no, there's actually nobody's got audited yet, and I say I could just erase my name from the tax return if it does, and I could still have a perfect record. But no, people have already been audited though. When they go after taxpayers, they generally they're only trying to make money. That's their basic goal. Remember, they get a salary. Their job the IRS's job is to collect money so that the government can run efficiently and effectively and pay for things. By wasting time on somebody that might owe $100, looking from the perspective of the IRS agent, that's not a great way to advance your career. You spent a month of time, a few hundred hours on a case that results in minimal gains for the IRS. That again won't look good in terms of going up the chain in the IRS. They'd like to focus on profit, on tax, and bringing you more money. So if you're in a situation where your income's not that large, or you have limited interest income or something, that the odds are the IRS will not make you miserable and that will not ruin your life over that. If you have a few $100 million in a offshore account in Bermuda that you haven't told the IRS about, and you've been making a lot of dividends and interest off it, and you never told the IRS, you have more to worry about, and we should definitely have a long discussion. But just always keep that in mind. Have some perspective in terms of how you approach the IRS. It is also, ultimately it's an honor system type situation. You are voluntarily telling the IRS what you did and did not make. I tell people that want to be extra aggressive or totally ignore the laws, and say, listen, anybody, you can tell the IRS anything you want to tell them. It's a function of, the dangers involved in doing so. Like I mentioned before, filing a false tax return, lying about how much income you earned, there are consequences, and there can be large penalties. So it's always, is it really worth the amount of money you might save in tax versus the potential penalties and difficulties that would occur later on. Now, one common issue for Americans living in Switzerland, living abroad, is often they do marry they marry aliens. The term for anybody who's not a U.S. resident or citizen is a non-resident alien. Basically, non-resident aliens don't exist to the IRS in the sense that they're not subject to any U.S. taxes, unless they actually have investments or make money from the U.S. But normally, as long as they have no real connection to the U.S., they are off the radar. The IRS doesn't care what these people do, and if you get married to one, that's fine, but it does affect how you can file your tax returns. When you're married to a non-resident alien, you have to either file something called married filing separately, or alternatively, you can also have the status of head of household, but that only happens if you have a dependent, basically a child, that would be included on your tax return. Now, what's relevant is that by filing married and filing separately, you kind of get the worst in treatment in terms of tax treatment. Tax rates are generally the highest. All sorts of basically relatively disadvantageous tax consequences occur as a result of filing separately. Now, and that's something to be aware of. That and it's an automatic. You can't file single anymore. The minute you're married, you have a limited number of options on how you're going to be filing. One thing also to remember is by law, being married, specifically, what does it mean to be married according to the IRS? You actually don't have to have a formal wedding. It doesn't have to be a religious wedding, or even registered with the local civil court or the government. If a couple purely live together and basically hold themselves out to be married, they're friends, they're known to be a married couple, they were married, even if they've not formally gone through the process in religious terms or in civil terms, the IRS considers them to be married, and all the laws, rules that would be associated with that apply to them. And so just for frame of reference on things. So like I said, it can be disadvantageous to include a non-American spouse to have to file with one. One of the alternatives that can kind of totally flip the situation is that you can file together with them if they make a special election. I've had many clients that have done this, and it even has certain advantages that normally you wouldn't be able to obtain. Basically, the non-American can choose to be an American for a specific number of years. Recently had a client where it was to their advantage to include their spouse from 2012 through 11 through 13. Those specific years. Before it was no good, and afterwards also 14 was no good. Those 3 years, it happened to be the spouse was not working. And consequently, their income, they had no income. And now, joined together on a tax return, it actually worked out great for them. But as soon as the spouse again started working again, it was no longer to their advantage. So they elected to stop being treated as a U.S. taxpayer. It has no actual connection with the immigration status. It's purely for tax purposes, and it can be very helpful. A lot of things can be done with it, but the catch is that you can only choose this once in the course of a person's marriage. And once this client that I was referring to before, now that the spouse can never again elect or request to be treated as a U.S. taxpayer. So you always have to be careful when you consider, do I want to make this election where they're going to get treated as a U.S. taxpayer and all their income will be subject to tax in the United States. That once you cancel it, once you elect it and then cancel it, you can't choose it again. And so it's a one-shot deal. I mentioned in the last seminar, in theory, there is one potential way of getting out of that, getting a second election. That would be if the couple actually got divorced, really properly divorced, and then got remarried, then actually they would be allowed to do it all over again. They could make the election over. So it's a lot of effort and potentially very expensive, way of going about it. And it would have to also, remember I said that you don't actually, if you hold yourself out to be married, you are considered to still be married. So even if they went through the process, they went to the court, paid the lawyer fees, pissed away a ton of money on the divorce process, they would still have to actually kind of make people believe at least that they're divorced. And then, even then, the IRS might be suspicious and want to really prove that, let me see some hate letters going back and forth. But basically, that would be the only way to pull that off. So I've yet to have a client who actually was interested in doing that, but just saying it is possible. Yes, the alien, non-resident alien spouse income, if they aren't included on the tax return, all their income doesn't count. It's off limits to the IRS. They have no connection to it. The IRS has no connection to it and is not subject to any taxation. There are questions about what happens if there are joint accounts. Earned income normally is divided between between the spouses, that's normally that's how they, if you have a joint account and there's interest and there's $10,000 of interest, if you file separately, normally it gets divided at 50-50. But when one spouse is not American, it could, theoretically, you could say this could work to the advantage of the spouse who is American, because now, depending on, let's say beforehand, before they got married, it all belonged to the spouse, and the guy has, $100,000 in the bank, and he gets $10,000 a year of interest, and he was having to report all the tax. And then suddenly he gets married, and he puts his wife's name on the account. It's a joint account. What happens to that interest? Do we get to divide it in half now, and half goes to him, half goes to the non-American spouse, and all of a sudden he might get a benefit in terms of the taxation on it. It is a bit complicated. It definitely does it depends on where the money originally came from and kind of the nature of the account, because it's partially dependent on whether the money in the account was gifted to the wife or not, or to the spouse, the non-American spouse. And it can work in reverse as well. The money could have belonged to the non-American, all of a sudden the American's name is on it, but really the income generated by that principal doesn't belong. It belongs to the non-American. And it's more of an art with these types of situations. Often, based on some of the case law I've seen, it appears that it usually the taxation kind of leans towards where the source of the money came from, who originally put the money into the investment account, and that kind of can determine how the income emanating from that account gets taxed. But again, even with that, there are ways around it. If somebody actually gifts, makes a formal statement of gifting money to the spouse, to the non-American, then half the income, or even all their income, if they give the whole thing to a spouse, will be attributed to the non-American, and that could definitely be used as a planning mechanism, as a way of helping. But it gets into other problems I'll mention later about gifting. Gifting right now. Every American is allowed to gift pretty much as much as they want, up to $5 million in the course of their life and death. It's a combination. There's a formula to it, I guess, but basically, it's something to keep in mind. If somebody can give away $5 million between the gifts and the inheritance, if they give away $4 million while they're alive, and then their estate is only $1 million, there'll be no gift tax, and everything's fine. Just before I forget, gifts given gifts given by an American to a to anybody actually above the annual exclusion, you have to report every year. Not reporting could subject you to fines. There is an annual exclusion of $14,000 to everybody in the world. You can give $14,000 to anybody, daughter, son, relative, friend, doesn't matter. American, non-American, it doesn't matter. You can $14,000 and you never have to report any of it, and it wouldn't go towards that $5 million number I mentioned before. And by the way, I'm not specifying exactly how much the $5 million is, because it actually changes from year to year. There have been a few years ago, there actually was no limit on it. It's kind of like the Congress can move it up and down if they want. So, going forward, 3 years from now, I don't want you to think, oh, it's exactly 5.25, whatever it is. It changes, it moves from year to year, and it could go down. What?
That's for receiving the gift.
No, giving. You'll never pay tax on receiving a gift. Any American who receives a gift, you never have to worry about paying tax on it.
But it's income.
No, it's not.
No, it's not.
Gifts are not income. You didn't earn it. That's a major factor, is earning it. And you can say, well, why lottery? You know, you win the lottery, did you really earn it? Technically, it's a gamble, and you did put money down to win it in the first place.
Oh, you did.
And, well, hopefully, I
Yeah,
presume.
buy a
you-
ticket.
Yeah, and then if you, you know, there are certain, you know, you say, well, what if I got the ticket as a gift? Then I didn't earn it, right? The Irish, I don't think they don't really, then it's a prize, basically. It's kind of like if you know, get lucky and throw a ball in from mid-court, it's kind of fun, it's still tax, don't worry, you're gonna pay tax on it. So the $14,000 though, you can give it to everybody, anybody, and if spouses are both Americans or joint tax returns, each spouse can give the $14,000 to each person. You know, let's say spouse, husband, wife, they have 2 kids. Each the husband and wife can give 14 to one and 14 to the other, and you know they never deal with that, and it doesn't even nothing would count towards the 5 million, and they would never have to report anything to the IRS either. And it's yeah. You got a question?
What about loans? If I wanted to loan more than give my son, for example, more than 14,000,
It has to be-
100,000 in a year.
Right.
And loan it to him.
You could do that, but the loan has to look, and it has to be a real loan.
But what does it take to make it a real
Ah.
loan?
It basically has to be, at the very least, it would need to be something that could be enforced in, I guess, local law, Swiss law. It has to be something that could be enforceable. It has to have some interest attached to it,
It has to
and
have-
the interest
in
has to get
Swiss-
paid.
Swiss, I don't have to have interest attached to it, I understand. I can loan it to him under the Swiss law
Right.
and not charge interest.
In America, you have to have interest. They say
How much?
a loan without interest
Like
is a loan.
1%
That's
is
not a
fine,
loan, that's a
right?
gift. I mean, just,
Yeah, it is a gift. It's
right.
supposed to be a
Well,
gift.
that's the point. They know they know. Well, you're not really loaning the money. They,
But so how much interest would it have to be?
Actually, the IRS does list what is the annual percentage rate. There's a rate on these on loans. It's actually pretty low. It's not a very high number. Off the top of my head, I don't remember what it is. But afterwards, I can get it to you.
So it changes by year depending on.
Changes by quarter.
By quarter.
Every quarter it can change. So I mean, but they're long-term loans. You could write it up according to. You know, call me up and we can work it out. And I can tell you exactly what you'll need. You want a 5-year loan, 2-year loan, whatever it is. You can work it out so it can comply by the IRS rules of what a real loan looks like. And if you do that, then that doesn't count towards the would not count.
Ari,
Do you need to say that if I had 5 children and I want to give each one 14,000 and the total is 70,000, I can lower my gross income by 70,000?
No,
No.
you
Because
just don't have to
I
pay any
gifted?
tax on that gift. That doesn't help you on the tax return, though. If you make money, if you have a $200,000 salary,
Yeah.
the gifts don't help you. They won't have any impact on how much tax you're going to pay.
Oh,
They just won't tax you on. You just would not have to deal with the gift tax. Like I said, gift tax is totally separate. It has nothing to do with income. It's just a separate tax that exists on kind of I guess transfer of wealth, generational transfer of wealth. I guess it's conceptual.
So they don't have to pay the tax, the children receiving.
No, and remember, the receiver, very crucial. If you ever get a gift from anybody, is never subject to tax. There's one slight exception where there's an inheritance and beneficiaries, but generally, you get a gift from somebody, you'll never have to worry about paying tax on the gift itself. And that's the rule. The giver of the gift is the one that potentially has issues if they break that $5 million barrier. And that $5 million, though, the key is the calculation of that. So the minute somebody gives a gift of $14,000 and one, $14,001, they would have to now report the 709 form, and it's a pain. You have to do it. You have to tell the IRS, oh, by the way, I gave more than the limit, and we gotta accordingly take that into consideration when we calculate how much I've given in the course of my lifetime, and the inheritance. And the estate. Like I said, $5 million is the combination of gifts during your lifetime and what's given in the form of the estate after death. Yes.
Hey, you say taxes, gifts that are received aren't taxed, but do you have to declare them?
Gifts that are received from an American are not
From
not
an
to
American.
declare. From a non-American,
No, from an American,
From
like
an
if my
American.
mother back in
your
Virginia.
mom,
gives
you
me
have to
money.
report nothing.
Okay.
Totally not, you have nothing to report. She gives you gifts of cash, that's her problem, not yours. If you get it from a non-American, however, exceeding the $100,000, there is you do have to report that. Well, you get, grandparents that are non-American. That's a classic example of how that can happen. Or a parent that's non-American, you're American, boom, they give you a large gift. You inherit a lot of money exceeding the $100,000. You need to report it to the IRS, and that reporting is, a problem and is subject to penalties. And so it's something in terms of reporting to be aware of. Now, something that comes into play often is the gifts that people receive if they're not cash. Somebody gets stock, somebody gets a company. When you receive a gift, you have to take the basis as it's received from the giver.
Sorry, just.
Oh, yeah, you were asking a question
Yeah,
before, sorry.
could you go back
Sure.
a slide just to get into the same.
And by the way, I will be sending out this PDF of the slideshow later on.
But here you are talking, the 133,000, it's from a U.S. spouse to a U.S. spouse.
No, okay, sorry about that. I'm sorry, I lost track of that one. From a U.S. spouse to a U.S. spouse, there's no limits on the amount of on the amount of gifts that you can give.
Yeah.
Absolutely no limits. You can.
And that's not.
$100 million. It doesn't matter. And the reason is because the
There are
IRS. Yeah, go for it. Let's go for the best. You can give as much as you want, and conceptually, what's going on is the IRS is not worried about you giving a gift to another American because they figure eventually, they're going to have to deal with the problem. At least another American spouse. They'll have to deal with the issues of gift tax, and they won't be off. They won't kind of disappear from the system. If you give money to a non-American, however, they have no obligations to deal with the IRS or report to the IRS or pay taxes to the IRS. And so the IRS wants, to keep their hands on it and keep tabs on what's going on. And so as soon as you're dealing with a non-American spouse, they do set the limit of $133,000. And when you combine it with 14, so you can get to 147, and you can do that every year. And it is a way of at least slightly moving certain assets and potentially reducing, working towards that the $5 million. At least, let's say somebody has $6 million of assets, and they want to avoid the estate tax and the gift tax, whatever, and they haven't given anything yet. They're starting from scratch, and they got $6 million. They've never given a gift to anybody in the world, and now all of a sudden they want to start dealing with. They realize there's going to be a problem. Every year they can give 147 to their spouse for the next X number of years, and they can get themselves below the, at that point their assets would be below the $5 million, and now they have to worry. They could die in peace, and the inheritance won't break the $5 million, and there won't be any gift tax. So that's a strategy that can be employed, but a key factor to be aware of is if a part of their, let's say $5 million, $6 million of wealth that somebody might have, let's say it was almost no cash, and it's all, they just own a house. They bought the house for $10,000, and now it's worth $6 million. Got a really good deal on it. Great location. They bought it a long time ago. Even if they got it gifted to them. Basically, when you have a large gain like that, like I said, went $10,000 to $6 million. If you gift it to another American, the American receives the gift, and on their books, the cost of that house is still $10,000. Why that's relevant is that somebody gives you a gift, $10,000. Grandfather, whatever it is, somebody wants to give you before they die wants to give you this gift. So it's a house. Right? You got almost a $6 million capital gain that's going to is on the potentially on the books once it gets sold. The minute you sell it, you have to report a $6 million gain to the IRS, and you're going to be paying well over $2 million of tax on that sale on the property, and that's kind of endemic to any gift that is even received. You receive a gift of something, anything that's not cash, that's not a risk, but it's something to be aware of. That asset, if it's sold for a big gain, you're going to be paying some tax on it. And the reverse actually also is something to be aware of, that that $147,000 limit that you can give, that applies to the basis of something. So let's say an American has, you own a house, and you want to get it out of your name, you want to put it in your wife's name, and she's not American. Every transfer that you make, let's say you transfer half the value of the house, it's worth $300,000, and then you transfer half the house to her. So technically, you'd say, well, that's 50% of a house, it's worth $300,000, so it's a $150,000 transfer, and it's pretty much close to the limit. So whatever, a little bit of extra tax, a little bit of gift tax, money that a little bit of it would go towards the gift tax calculation, $5 million. But what is so that element's not a problem. However, the gain on that house is potentially a big problem that you might have to have, because when you gift property, assets, stock to a non-American, any gain that exists at that point, again, you bought the house, let's say you bought the house for $300,000, now it's worth $1 million. So technically, if you were to sell it today, you would have a $700,000 gain. By giving half of it to the spouse, theoretically they're not American, all that taxable income would just disappear. So the IRS has a clawback basically, where they say, oh no, when you gift that house to your spouse, the non-American spouse, it's as if you sold the property to them at the current value. So whatever gains, so it's half the value of the house, it's a $500,000 sale kind of. You bought it for $300,000. You give half, so that's a $150,000 gift that you give them. So that's $350,000 of gain that you will need to recognize on your tax return and pay taxes on it, even though you didn't sell it. You didn't actually sell the house, and you certainly didn't receive any income, but you will be paying tax on the $350,000 gain, because conceptually, when you give, if you can give these gifts to the spouse. After a property, after it's already increased in value, it would be a great way to never have to pay tax. Just, you have these, it's like you bought Microsoft, in 1980, and now it's worth, $100 million. Just to magically say, oh no, here's a gift to her, and she's not American, and she won't pay any tax on it. And everybody's happy, right? And it would be just a great strategy to always avoid paying taxes, on assets that have appreciated in value. Just move it into somebody who's not American, who doesn't pay taxes anymore, and problem solved. And so that's what I said, the IRS basically views it, the minute you give that gift, it's as if you sold it, and then you have to recognize and deal with the tax consequences of however that sale worked. And one key factor that also comes in, I had a client recently who basically, she bought a company. She was part of a startup company. The husband really ran the company. But she was one of the investors, put down like $1,000, and now, 10 years later, it's worth $1 million. So huge capital gain that she's going to have to deal with, and there's no way for her really. If she gifts it away to the husband, she's going to have to treat it as if it was a sale, so that doesn't accomplish anything. There aren't very many good options, but one key factor, and that is relevant to what I'm saying now, is the valuation element. And this is where you definitely have to consider, well, what's the value of the company? Sometimes, if it's on a public stock exchange, it's quite easy to know what the value of an asset is. But where it's a closely held company, it has a certain amount of business, to determine what its true value is a bit of an art. And even the IRS recognizing that sometimes they'll rely on experts to come in and to determine what value we're going to attribute to that company, and consequently that's what would result in the taxation of it if it was gifted away. So, we'll figure out that number minus the basis, and that gives us what we will tax. U.S. citizens that own more than 50% of foreign corporations, they might need to pay tax on the income of that foreign corporation, even if they don't take any dividends or even salary from it. The IRS long ago realized that people could use offshore companies to avoid paying any tax in the United States. basically shielding it from the IRS. There was so they created these rules to cut back on that. I guess one scenario would be that you own a factory in India, and all the income from that factory normally would have gone into your pocket when you're living in New York. It doesn't matter actually, you're American, so you're going to pay taxes on that income, that profit. But instead, they would have their offshore shell company own the Indian corporation, the Indian factory, and they would just let all the profit accumulate into that corporation, and they wouldn't take any dividends from it, and they would just let it sit tax-free in this corporation, and the corporation itself might use the money to invest in other things, and it would be this great investment vehicle. It would be never subject to tax, because until you pull out money from it, you distribute money in the form of dividends, normally, the money grows, would keep growing. So the IRS cut down on that when under certain circumstances. If it's in your home country, it kind of depends where that corporation is in reference to when you have to recognize the income that the corporation earns. But it's important to know that for sure you're going to have to report it, and the question is when and if you're going to have to pay income, even on money that you don't distribute to yourself. One solution that some people have thought of was, I'll just have my non-American spouse own half the company, and then I won't have to worry about reporting any of the income that it accumulates. And that strategy can sometimes actually work, depending on a number of factors, but it can actually sometimes work. But there are a number of criteria to even get close to making that viable. And importantly, you'd still have to report it every year. The IRS, the way it treats these corporations is if you have a husband and wife, and even if the wife is not American, and they both own, a corporation, normally if she's American, her ownership and his percentage would be lumped together, and they treat the couple as if they own him or her really, as if they own 100%. And then, there are a number of consequences of owning 100%. When it's a non-American, then for purposes of the pulling of ascribing income from the corporation, it wouldn't be considered as owned majority by an American, but he would still have to report all the income. He would still have to basically report that tax return, that company, to the IRS. It would have all the reporting requirements. Now, I guess one other thing, just actually before I forget on here, we'll get to it in a minute, but just as a quick heads up, by reducing the ownership below 50% or to 50%, like I said, you can avoid being something called a controlled foreign corporation, and some of the most negative tax consequences, particularly something called subpart F income, which is when that foreign corporation earns income in certain ways, the income flows through into your tax return. And that can be, defeat all the purposes of, setting up the corporation in the first place. Now, some people say, I'll just have my spouse own 50% or more, and thereby it would not be legally classified as a controlled foreign corporation. It won't be subject to subpart F, and everything's great. Except in that case, these corporations often then get lumped into a category of being called passive foreign investment companies. And that basically does the same thing. The income would have to flow into your tax return, or you have a series of other options that are not so pleasant. So in short, offshore companies, offshore corporations can be a very good tax planning tool. But you got to be careful how you use them, or else they absolutely don't work and it defeats the purpose. The FBAR, got to report all of your accounts.
What's the
The FBAR. You have to report all of your foreign financial accounts, bank, investment accounts, Pillar 2, Pillar 3. All accounts have to be on your FBAR. The FBAR the minimum is $10,000 in any currency combined. The number that's used is the highest balance in the course of the year.
The highest balance of each account added up.
No, the highest balance is all the accounts over the course of the year, on one day during the course of the year. which could be awfully difficult to have to calculate that, because you basically need to come up with a spreadsheet, have every single account, balance on every single day, and then kind of do a sum on the side and figure out which day had the highest balance for all of them combined. And that's technically what they want. They don't want the highest balance because, give me a scenario of how that could be misleading. If you took, let's imagine you have 10 accounts, and in the course of the year, you start out the year with $10,000 in one account. And for whatever weird reason, you keep moving it from account to account. So at the end of the year, each account at one point had the $10,000 in it. So now, if we were to go the highest balance on all of them, the calculation on the FBAR would look like that you had $100,000. Because you said I had 10,000 in this account, 10,000 in that account, 10,000, all 10 accounts, I had 10,000. And that would be misleading. That's not kind of what the IRS wants to know about. Just money moving around and then inflating the account when, in fact, most of the year its balance was zero, is not what they're looking for. And also, like I said, it's misleading. It implies that you had $100,000 at a certain point when that was far from being the case. So,
Let me be clear on this. If I have this money in the United States, nobody will ask me about it.
yes.
Correct.
But
Yes.
if I have that same money here, I have to report it.
Yep. That's the way it works.
But they're not going to do anything about it.
There's no tax on the FBAR. There's no tax on reporting how much income how
Why
much
do they
how much
want
assets you are.
What's the benefit of knowing?
They're just nosy.
They like to know. I mean, listen, the NSA, Snowden, they really like to know what's going on. And I mean, listen, they created the FBAR to reduce, for money laundering purposes, to cut down, to make money laundering difficult, to indirectly to make terrorism, to try to slow down, cut down on terrorism, the funding for it, which obviously involves money laundering, and also for tax evasion. Often it ends up being almost like a double jeopardy type of tool, because often when people get nailed for tax fraud, they've been hiding vast sums of money offshore and earning lots of interest and dividends, not reporting to the IRS, and then they get caught. And the penalties are very significant for not reporting $500,000 per year of interest income that they never reported to the IRS. So the tax on that is close to $200,000. There'll be some more penalties, and then there'll be all sorts of extra penalties they'll throw on, interest.